Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland, Director of Freight Market Intelligence here at FreightWaves, and as usual, here with John Paul Hampstead, Director of Passport Research. And here's where we discuss what's happening in the freight market and hopefully give everybody a little bit of insight on what's going on in the freight market this week. So we've had, again, another increase in outbound tender volumes, increase in tender rejection rates.
Right.
Capacity appears to be just tightening every single week at this point. We have a long, sustainable run. And I think the question on most people's minds, and I know that I've had some conversations this week, is how long is this going to last and the sustainability of it? Do you have any thoughts on that, JP?
Yeah, so tender rejections are now above 22%, which is very tight.
It's reminiscent of 2018. That was
really
the last
is.
time we saw that.
Yeah, and in terms of sustainability, I mean, I think, you look at personal consumption expenditures on durable goods and non-durable goods, they're elevated by like 20% year over year. They started the year off at a normal sort of like tepid economic growth, like 2% up, 3% up, whatever. But as services spending plummeted, goods spending went up. So when you think about whether the current freight volume rally is sustainable or not, it's important to keep in mind that this rally is not happening in spite of COVID-19. It's happening because of COVID-19. So when you think about what could end the rally, it's not things like a second wave of infections or stay-at-home orders or working from home. That's actually what's driving the volume.
That's a really good point. I like the fact that we're talking about how it's the change of behavior in the marketplace that has created this surge. I mean, it's not just consumer behavior, but it's also business behavior. All those capital expenditure budgets that we were talking about early in the year that got slashed, they're spending it in other ways. I mean, they're not spending all of it, and obviously a lot of these companies, as reported, are sitting on a lot of cash right now. Again, lends credence to the fact that maybe there could be another boom later in the year, yet to be seen. But
the trucking companies are ordering trucks now.
Yeah, they're back. What do you know? The spot market blows up and back to adding capacity. But again, that's a different form of capacity than like an owner operator adding, jumping back in the truck.
And I think that's a lot of replenishment as well. I think that people let their fleets age in 2019. There's going to be a shortage of drivers this year with 100,000 fewer student drivers graduating from driving schools.
A lot of the schools were shut down for a period of time.
So like it's not the case that they're going to be able to seat a much higher number of trucks. I think they're just they're going to add capacity incrementally, and then as the used truck market improves, they'll start to recycle through it.
Yeah, I was talking to a guy actually that worked in the used truck market, and he said that there were all sorts of hang-ups in getting a used truck right now because of the COVID-19 outbreak, and the procedures of selling trucks right now has become more complicated. And I'm not a used truck specialist by any means, but there were a few little nuances about how they changed their process of getting rid of some trucks. So that also could be hanging up or a headwind and getting some of these owner operators or smaller fleets some of this equipment later in the year.
One of the interesting earnings reports that actually from last night after the markets closed I did want to talk about was Uber and Uber Freight. That had a really interesting quarter and kind of a turning point maybe for that entire operation, because for the first, so they grew gross bookings for Uber Freight quarter over quarter, which snapped a 2-quarter slide in gross bookings. If you remember, Uber Freight gross revenue had peaked in the third quarter of 2019, had fallen in Q4 and fallen in Q1.
Right.
I think a lot of that was due to the way that the larger company was pivoting toward profitability, and there were reports, rumors, and also I think some of it was reported in the media about Uber Freight repricing some contracted business that they had pursued a little bit too aggressively, giving back freight.
Traditional market share play for the broker.
Yeah, and then
basically pricing things really low so they can capture a bunch of the market as they're entering it.
Right, and then they had to give some of it back, so gross revenue started falling. But when you look at Q2, for the first time, I think this is for the first time, they grew revenue sequentially while at the same time cutting EBITDA losses sequentially.
So they grew their margins and they also expanded revenue.
Right, which tells me that they might be over the hump of repricing that contracted freight that wasn't really working for them. I mean, granted, they still lost $49 million in 90 days, but that's much less than $64 million, right? And so it seems like Q over Q growth will be positive but moderate, and they're going to lose less and less money going forward. I don't know. I was really encouraged and impressed by their result. It sounds like they've turned the ship in a meaningful direction.
But do you think this is part of the market, just the side effect of having a super hot market, so they could go out and not necessarily, just take advantage of some of this super hot?
I do think it's part of that. I mean, they integrated with SAP and BlueJay, right? They reported that in the second quarter they saw it was like a 200% increase in spot loads tendered to them through APIs. Right. So in that case, you say like, okay, who has the most frictionless user experience for booking a truck? They're actually in a great position to capture upside when markets tighten, right?
Right.
Now, who knows how much it costs them to execute on the other end?
That booking.
but hitting that button seems to be a lot easier than having some awkward and difficult conversations with brokers who are really trying to gouge you. And you call them at 4 o'clock on a Friday.
Yeah, and to your point about how they've been going through this process of repricing their freight, that probably helped them out during the timing wise, as people were kind of still in that cycle of bottoming out their rates earlier in the year. They were trying to bring them back up and get, kind of shed some of that low margin freight, or obviously there's some loser freight out there.
Yeah. The only other thing I want to say about Uber is just that I thought it was really fascinating that they changed the name of Eats to Delivery. So they have rides, delivery, freight, and other bets, which are like helicopters and bikes and like self-driving trucks.
Best Eats worldwide.
Yeah, but delivery is interesting. They're actually getting into parcel delivery. So they have a program called Uber Connect where I could send you a package. It's like local distances, right? So like from like Red Bank to Ottawa, I could send you a package, and Uber can pick it up from my house and take it to you. They've already done like 3 million of those shipments. I wouldn't be surprised if they got into like omni-channel fulfillment.
That's actually a fantastic idea.
Like my CVS order, right?
Yeah.
I don't want to, I'm trying to put my kid to bed or whatever. I can't go to CVS, but I need like 10 things. Why can't I just get Uber to pick it up for me?
Yeah. And a lot of people obviously we're switching from that DC style supply chain to a fulfillment center. A lot of people getting these packages at home now.
And they already have a great driver network. They need different sources of demand to get like asset utilization and keep these drivers like happy and paid and stuff. And I really think that you'll see deals coming out with omni-channel fulfillment.
It is an interesting addition to the gig economy, as it were. Obviously, they've lost a lot of the need for their rideshare programs.
Yeah, and a lot of their drivers are making more on unemployment than they were driving cars. And so I don't know if the last time you tried to book an Uber, it was the last weekend for me, and I had to like schedule it. And someone came up, and the woman was like, "Yeah, I'm like one of 5 people driving Chattanooga." In any case. I do want to talk about some interesting intel that we've heard about the way that different sort of modes of transportation are responding to the hot freight environment that we're seeing right now.
Yeah, we are, I'll touch on it real fast and then I'll toss to you real quick. So we are, for the first time in a long time, seeing flatbed rejection rates tick up the last couple of days. Again, the industrial economy, I wrote about it last week in the chart of the week, and even the week before, saying the industrial economy is showing signs of life. And we have, had this period of time where the freight market's been very active without the industrial economy really boosting that volume. A lot of it's been, as we talked about, omni-channel, fulfillment center changes, transitions in supply chains, warehouse to warehouse. all sorts of inventory management, but also just these change of freight type, et cetera. I mean, it's been without all of these carloads and raw materials and parts that normally drive a lot of the freight market. The oil market's finally coming back.
Yeah.
Again, a huge part of the industrial economy. So all of these things line up to, now with the flatbed rejection rate finally starting to tick up, it tells me that the industrial part of the economy is now going to add to the already tight environment.
We've done a little bit of work on this, and the flatbed tender rejections are actually a really highly correlated predictor of industrial production. It's interesting because iPro is like a dot, right? A point that comes out every month, and this is again a curve, but it predicts like the movement of industrial production like quite well.
Right. And so what are we also hearing? We've heard some stuff about, how some of these carriers are managing their business again. We talked about repricing contracts.
Yeah, so the 3PLs, especially ones who source trucking capacity on the spot market, and therefore are very exposed to freight cycles, have been, I talked to hedge fund manager yesterday who works on transports. He said that large 3PLs are tearing up contracts left and right.
So 3PLs for LTL carriers?
No, this is truckload and LTL. We also heard about specific LTL carriers that are going to their 3PLs, providers, right?
Yep.
Like so if you imagine an LTL carrier, the LTL brokers that book their trucks, they're turning around saying the number we heard was they raised rates on their brokers by 21%, which is basically, to me, that signals we have enough freight, now we can manage yields.
And I think too, this speaks to the fact that we came out of a soft market in 2019, underpriced some contracts. Obviously a super volatile 2020. We've had our lows and our highs, but again, very similar in the way that we, a lot of these contracts came down earlier in the year. Now the spot market has been active for several months, probably 2 months, I would say, has been very active. And that just is not going to work for these brokers. At the same time, these asset-based carriers that utilize brokers for freight, they're not going to just get this inconsistent type of freight. LTL carriers specifically need to know what's coming, what type of freight's happening. 3PLs typically don't have a very consistent type of freight for LTL, so they have to stack those pallets on the truck consistently. Truckload, of course, they use brokers typically as supplements or ways to get backhauls back or other types of movements that they don't have consistent moves for.
And right now their contract freight is probably blowing up, right?
Yeah.
And so they need their brokers much less.
Yeah.
Now, truckload carriers are also, benefiting from this environment, obviously, making a lot more money, utilizing their assets, reseating trucks to the extent they can. We think it's going to be a little bit later until they reprice contract freight, simply because they can honor their commitments longer. They have much better cost control. Right. But we think that they may actually wait until around October.
Well, they don't have to honor these contracts. They can hop into the spot market because their door's getting beaten down right now.
Yeah.
This is typically the other way around with the shippers.
Right. So, a lot of what we're hearing is that they're honoring sort of like their basic contractual commitments and rejecting surge freight.
Right.
But, the thinking now is that carriers will wait until it's undeniable that they have pricing power in October, and then they'll get returned to the shippers and ask for rate increases.
So we've got about a minute left. I'll chime in with my pricing guy hat real quick. I think that we will see some rate increases this year. I think we are going to see this sustained for a little bit longer. Moving into the third and fourth quarter when it is traditional bid season, but I don't think that we're going to see those 8-9% rate increases that we saw in 2017-18, simply because we don't have, there's still a lot of uncertainty in the environment. We don't have a lot of that, optimism about the future that we had back then.
That makes sense. Yeah, I think a long-term narrative is crucial for justifying, like, okay, your rate should be higher for the next 12 months.
Yeah, I think back in 2018 there were 2 rate increase cycles even back then. So It didn't work out great for the carriers as they pulled a lot of that back. Well, JP, thank you as always. That wraps up our episode of On the Spot this week. And as usual, stay tuned to FreightWaves.com and FreightWaves Live for any future freight market updates. Have a great week.